Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk about how to minimize your largest lifetime expense, that is tax. Now, it might sound a bit strange, but tax isn't necessarily a bad thing. I mean, if you're paying tax, it means you're either making money, either income or capital gains. But of course, I think we all agree we probably don't want to have to donate any more than we legally have to. And so what I wanted to do is go through a few considerations to maybe what I would describe as a common sense approach to minimising tax. My first comment would be that I think minimising risk is sometimes just as important as minimising tax. So it's not really worth it to bend or break a law just to save a few $100s of tax. So, for example, if you claim a potential deduction that might be a little bit rubbery, for example, and then you get audited, you certainly don't want to attract the attention of the ATO, because it might mean that they look at future returns a little bit closer. Just to save a couple of $100, it's really not worthwhile sort of bending those rules. So my approach has always been to stick within the black letter of the law. Bending the law is rarely worthwhile, as I said. Of course, you should claim whatever you're legitimately entitled to claim, but trying to get too tricky with it, as I said, I would much rather stay under the radar and pay my fair share of tax than really push the envelope and invite an audit. And remember, when you sign off on your tax return, you are taking the risk as the taxpayer, not your accountant. So it's you that will have to stump up the penalties and interest should you get audited and should you get a revised tax bill down the track. The second comment is that certainly with more complex tax minimisation arrangements, tax is often only delayed rather than avoided completely. So that's the problem with aggressive tax minimalisation. Firstly, you've got to pay a tax advisor or a specialist accountant a large sum of money to sort of come up with this complex, often convoluted strategy. And then even the best plans can be thwarted by the ATO by just issuing a new tax ruling, a practice statement, a change in law, whatever it might be. And all of a sudden, the arrangement that you thought was perfect a couple of years ago that cost you a lot of money to set up, all of a sudden you've then got to unwind it or deal with it. And really, these sorts of complex arrangements just invite complexity, risk, and most importantly, cost. And it's a good business model for some tax advisors, but I just don't believe in it. It's appropriate in some circumstances, of course, but for most people, I would say try and keep it as simple as possible, save as much tax, but don't invite too much complexity. Okay, so when we discuss tax minimisation, I really think in terms of pre-retirement and then post-retirement. So pre-retirement is obviously when you're working, you're earning personal exertion income, those sorts of things, versus retirement when you're just relying on investment income or super and so forth. So let's talk about a couple of pre-retirement strategies. Now, the first one is just come to terms with the fact that if you are a PAYG employee or you earn personal services income, and if you want to know more about what is included in personal services income, we certainly have a look at the Holistic Accountant podcast that Mina and I have recorded where we talk about that. But really, if you earn PSI income or you're a PAYG employee, you're just going to have to make friends with the fact that there's not too many opportunities for you to be able to reduce the amount of tax. Now, if you are certain sort of occupations like a medico or a barrister, there can be other opportunities for specific occupations to reduce tax. But in the main, for most people, there's not a lot of ways to reduce tax. And so my advice then is to focus on other taxes, such as stamp duty, land tax, these sorts of things, rather than and capital gains tax rather than income tax. I'll talk about that in a second. But there are a couple of really obvious ones or opportunities for PAYG employees. The first one is contributing to super. So after 1 July, the concessional contribution cap increases from $25,000 to $27,500. That means people can contribute up to $27,500 a year into super and claim a tax deduction for it. Now that $27,500 contribution cap includes the 9.5% that your employer contributes on your behalf, those compulsory contributions. Now that's slated to increase to 10% after 1 July 2021, by the way. So your employer will be making more contributions. Any monies contributed into super will be taxed at a flat 15%, whereas outside super you might be taxed at, say, 39 or 47%. So there's quite a bit of tax saving, although if you are on a high income, over $250,000 a year, then your super contributions will actually be taxed at 30%. So there's still a tax saving from doing that, but maybe not as much as lower income earners. The second obvious way to reduce tax is through gearing, so borrowing to invest. It's really about using other people's money, that is the banks, to build your wealth, and you're able then to use pre-tax dollars to meet the interest cost associated with that borrowing. So it used to be very tax effective when interest rates were 6, 7, 8%. Of course, there is still some tax benefits available, but they've greatly reduced compared to where interest rates were many years ago. So apart from super and gearing, for most PAYG employees, there's not a lot of other tax saving measures. But as I said at the beginning, your focus then should revert to making sure that you're paying less tax on any investments, including income tax, capital gains tax and land tax. So let's talk about then the ways that you can minimise the amount of tax that you pay on investment returns. Because obviously it's great to generate an investment return, but if all of it is taxable in the year that you generate it, then really what you're doing is paying half of that return to the ATO. There's less then to reinvest. 2 tips. The first thing is make sure you're investing in assets that generate most of their return in terms of capital growth. Because obviously we don't need to pay capital gains tax until we sell the asset. So if we're getting most of our return in unrealised gains, so capital growth, we get to reinvest that each year. That is, the tax isn't subtracted or deducted each year. So for example, residential property tends to provide most of its return in capital growth. But if we look at share market investments, for example, if we compare, say, an actively managed fund and an index fund, quite often an actively managed fund has a lot of turnover, a lot of stock turnover within the fund, and most of the return each year is taxable as a result. Whereas an index fund has far less turnover, and therefore you'll generate some realised returns, some dividends. But again, especially if it's an international share or international fund, index fund, most of the returns will be unrealised gains and therefore attract substantially less tax. The second tip is to make sure the investments are owned tax effectively. So that could be putting it in the lowest spouse's income earner's name, or putting it in a family trust that provides you with flexibility. But think very carefully about asset ownership, because the owner really, the person or the entity that owns those investments really dictates, how many opportunities, tax savings opportunities there might be. Okay, the next consideration, which really only applies to property investors, is to minimise land tax. Land tax is probably one of the most insidious taxes, because when you first purchase an investment property, the land tax bill actually might be zero. You might not be actually paying any tax, because everyone has a tax-free threshold to take advantage of. But obviously, the longer you hold the property, and if you're investing in high land value property, as you should be, then the tax will start to accumulate year after year, and it will be probably at its highest levels as you just enter into retirement, at the time when you don't really want to do that. So it's good when, it's one of the advantages of sitting down and planning out a investment property portfolio initially, so you can work out, what is the implications of land tax long term, and how can we structure a portfolio to minimise that. And lastly, capital gains tax. Obviously, quality assets held for long term will provide that compounding capital growth, which is what you want them to do. But obviously, a side effect of that is that it will also create large unrealised capital gains tax liabilities as well. So something that we need to think about. It's great to invest in an asset, but if we sell it one day, we want to keep most of the profits, of course. So things like putting that asset in a family trust or a self-managed super fund might help you minimise or at least reduce the amount of capital gains tax you pay in the future. If you are self-employed or generate business income, so that's distinct obviously from what I just spoke about for employees and PSI, people and personal services income, then there could be a lot of avenues to actually save tax. And of course, a bit of a free plug for Mina and my new podcast called The Holistic Accountant. I recommend you have a listen to that, and we talk about lots of different tax saving measures for people that are in business in that podcast. Okay, so that discussion really relates to tax saving measures that are available to me if I'm mainly if I'm an employee before retirement. What about after retirement? Well, after retirement, your aim really should be to pay zero tax in retirement. So firstly, any assets held inside super in a pension phase do not attract any tax, income or capital gains tax if the member's balance is less than $1.7 million. That's a new benchmark after 1 July 2021. So that means really a couple, two spouses, can have up to $3.4 million in super and not pay any tax. So you want to be thinking about that very carefully, and that's a good ownership structure to start holding a lot of your wealth. If we think then outside of super, an individual can earn around about $22,500 and not pay any tax because of low income earners rebate and so forth. That means a retired couple can earn between them about $45,000 and not pay any income tax liabilities. But even if you exceed that benchmark, let's say you earn $55,000 between you, well, you'll end up paying about $2,500 of tax, or 4.5%. Let's put it in the whole scheme of things, it's really not a lot of tax. So if you project that your investment income will be less than $50,000 a year between you and your spouse, probably not a lot you need to do to worry about. You'll probably pay very little tax in retirement. However, if you project that your personal income in retirement could be in excess of $50,000, obviously excluding any pensions from super, then you need to start thinking about ways that you're going to be able to minimise tax in retirement, and that could be using vehicles such as family trusts to provide you with a bit more flexibility. But in summary, if you plan well, most people that complete that good, robust planning exercise will pay somewhere between no tax and very little tax in retirement. Now let me finish with just a word of warning, and it's going to be a bit contradictory, but of course you should save as much tax as you can, but once you've done that, move on. Focus on generating higher returns or better returns or more consistent investment returns, or increasing your personal income or building your personal wealth. Too much focus on tax is really not going to provide you very much benefits, because once you've, if you're a PAYG, there's not a lot you can do. Once you've contributed into super and you've got some gearings, that's it. You've considered then capital gains tax, land tax, and tax on investment returns. Once you've done that, move on. Move on and start thinking about more positive things like, how can I generate more returns? How can I build wealth? And put the tax thing aside. Sometimes I've come across people that are just too focused on tax, and there's just no reward for that focus, because there's only so much you can do. Obviously, having a good accountant, having a good independent financial advisor that has strong tax background, hopefully they're in fact registered tax agents, so they're able to provide taxation services, including tax advice, makes a lot of sense. So that's it for this week. Just a quick reminder, if you enjoy the podcast, please share it amongst family, friends and colleagues. And also, most importantly, leave a rating wherever you listen to the podcast, because it certainly helps. And I'd greatly appreciate it. Until next week, bye for now.